Hey, welcome to Financial Education Foundation. My name's Warren Shute, and I'm here on this lovely, kind of a bright day today with the lovely Paul. How are you today?
Hi, Warren. I'm good. You well?
I'm very good today, thank you. Very good. The sky is bright. I took the children to school this morning, and it was light. And I thought that was lovely. I've been going to school some mornings. It's been dark and miserable, and that really affects me. I think I get affected by that SAD syndrome. So I make sure I take extra vitamin D, particularly through the winter months.
I all your vitamins switched on because, I think this week we can only really talk about one thing, and that's what's been all over the news for months now, which is Brexit, the kind of impact, what we might see as a country and as individuals, and kind of your thoughts on delving beyond the headlines a little bit, let's say. There's been a lot come out this week in terms of economic modelling and scenarios of what's going to happen in various factors. And what's your take on this? What do you see? Where do you see us going?
Okay, so I think the first pre-frame I've got to start the conversation with is I'm an eternal optimist. I believe you shape your own destiny. And we were just talking, I push away as hard as I can anyone who tries to tell me what I can or can't do, what the future will lie, because I believe it. You do it. However, the message from Mark Carney was very concerning. It was very stark. And I think what's important to raise, and Nikki, my wife, talked about this, is it's the worst case scenario. It's the absolute worst case scenario that possibly could occur. I don't know how he knows that, obviously, because we haven't gone through the worst case scenario. But what his model says is the extreme that might occur. And what I wanted to do today is to bring a bit more, dare I say, almost like an informed, balanced view on the situation, to try and give a bit more knowledge. I think knowledge is power. And if you hear it from the news, you hear it from me, you continue to read, you're intelligent people listening to this, you can come to your own conclusion on how it will affect things. So there's two main things. First thing we're talking about is like if there's a no deal. I think if the Parliament votes on the deal that Theresa May has agreed with the European Union and it goes through, I think that would be a positive thing for the stock markets. Okay, because that's what we're talking about. I'm not talking about politics here. I'm purely talking about economics, how it's going to affect you. So I think if that deal gets agreed with the MPs, I think that'll be a positive thing for the stock market, because the stock markets like certainty. Okay, they don't like uncertainty. They're a forward-thinking, a forward-predicting machine, and they look out into the future and say, do I know what's likely to happen going forward? Yes. Okay, I'm going to price the value of the shares accordingly. And when they don't know what's going to go on in the future, i.e. we don't know if this deal is going to go through, we get a lot of volatility because we've got a lot of ups and downs. It's almost like a schizophrenic. Okay, so with the vote on the 12th of December, if that goes through Parliament, my theory or my thought would be that would give certainty to the market, and therefore the markets will start to recover or get a bit more stable, and life will carry on. We're not talking about whether it's good for the economy or not, or good for your business. That's another argument for a politician to make. It's really here just talking about the stock market. If the markets pick up, okay, then the economy is likely to pick up, and therefore interest rates are likely to pick up. Okay, so if interest rates pick up, we're more likely to see a slowing of property growth. Okay, but overall, that's not a bad thing for our economy, because it helps our first-time buyers get onto the market, and it allows savers to have a bit more interest. Hopefully, they'll pass it on to the banks will pass it on. If not, we should see better yields being paid by government or corporate bonds. So what I've kind of summarized there is if the deal gets agreed, we're more likely to see a stabilization in the stock market picking up, the economy then picking up because we have certainty, interest rates picking up because we need to slow the growth and curb inflation. The knock-on effects that will slow property prices, will hopefully allow a few more first-time buyers to get onto the market, and savers to have a bit more of a return on their fixed incomes. Okay, if there's a no-deal Brexit, and that basically means we can't come to an agreement whereby we agree the terms of exit with the European Union, then that gives uncertainty in the market. And in the short term, I mean the short term, and when I mean short term, I probably would estimate, and this is purely my opinion, it's not a fact, and you can't back me up on this, it's going to be between 18 months and 2 years of uncertainty in the stock market. And what that means is volatility. So if you're a retiree drawing down money from your pension, or if you have a capital sum that you live off, you want to make sure now, before that eventuality occurs, and you should do this anyway, you have at least 12 months, preferably 36 or maybe 60 months of your income in low-risk investments, either cash or low-risk bonds, because that's going to give you certainty. But I can be rest assured that the probability of that certainty going on beyond 3 years into 5 years is so small that it's something that we shouldn't really worry ourselves about. Okay, so a no-deal Brexit, we're going to see more volatility in the stock market. It's important to note, and I showed you this just before, I'll bring this up here. Okay, so this is a chart of the world stock markets, and it's based on market capitalization, so in other words, the size of the stock market. So this here, this big square here, at 54% of the overall stock market size, is the US. This is the United States of America. Its size is 54% of the overall value of the stock market. This little guy here, punching above its weight, 6%, is the United Kingdom. So the UK is 6%. It's almost a tenth smaller of the US. This is France at 3%. This is Switzerland at 3%. This is Germany at 3%. Netherlands at 1%. Belgium at less than 1%. All combined, the UK in Europe is around about 15%, 1/5. That's the UK at 6% and the rest at 9%. So we're talking about a microcosm of volatility in the stock markets, because although the trade may affect the US, I'm not convinced it will affect the US stock market as much as we think it will. If we look over the recent past, the last 3 years, certainly the last 18 months, the UK and Europe have been a lot of volatility because of Brexit. The S&P 500, up until very recently, has just been chundering along. Okay, and I think that up until very recently is due mainly down to the trade tariffs Trump has imposed with with China and the Far East, which he's more volatile than the stock market, so he'll switch those off as and when that affects the US economy. So
what does that picture of the world markets, what does that mean to us as investors, and how we're trying to protect our money in case of volatility?
Well, first thing it means is when you invest, you certainly should be globally diversified. The old-fashioned or the traditional way of investing was to have a home bias. In other words, of my stock market exposure, I'm going to have at least half of the money in the UK, my home. And therefore, the other half I will spread globally. There's been a lot of academic research to say that there's nothing to warrant that. And in fact, for a UK investor, actually having a globally diversified portfolio makes sense, because we get, of our stock market portion, 54% of it exposed to the US, where we have companies like Google and Apple and Salesforce and Netflix and Amazon who are taking over this world. We get exposure to their growth on a disproportionate level because we're not in the US. Okay, so your investment portfolio, I think the first thing is to make sure your level of risk is compatible with your tolerance and your capacity. So your tolerance is how much you can factor at night. So in other words, can I sleep well at night if this thing falls? But your capacity is it going to affect my standard of living? If it falls, if the stock market does fall, like it did in 2007, is it going to affect my standard of living? So we need to factor those two things. And typically the stock market as a whole will fall about 50% from a high to a low. So 2000, the dot-com bubble, in 2007, there was like a 50% retraction, okay, before it recovered. And there's nothing to say that wouldn't be the same again if there was a no-deal Brexit. But if you've got enough cash at the side and enough low-risk investments to tide you through, then you hopefully should weather the storm quite well. And if you're exposed to the US as well, that is unlikely to occur over there. I can't see the US having such a correction, because it doesn't really affect them per se, not in the same way it will affect the UK. So that's the stock market. One thing you've got going for us is, let's go on to exchange rate. I think there'll be a slide on the pound. Okay, so at the moment, I think our exchange rate is around £1 to €1.12, and they think that might fall back. Just want to bring up another chart. Okay, so I'm going to share my screen now. Hopefully this will work well. I hit share. Okay, can you now see a chart of xe.com?
Yes.
Yeah. Okay. So what you're looking at in front of you now is a chart of the pound euro over the last 10 years, basically. And you can see us here around this area here, and this here is about 112. Okay. Well, actually, previously in 2013, we were around a similar sort of level. And what I would say to you is, back in 13, did you do anything different? Okay, so economically, we were coming out of a more challenging time from 2007, but really, did you do anything different? So although it was a challenge, exchange rate-wise, it changed, we didn't, as I said on the call beforehand, we didn't revert to eating beans and toast. Okay, so although it's not ideal, it will affect things. It doesn't really affect things as much as some of the media might portray. Okay, and the other thing is the FTSE 100, which is the UK's largest 100 companies, derive a lot of their profits from outside of the UK. So if there is a slump on the pound, okay, the exchange rate goes against us. That means when they expatriate or they revalue their profits back into pounds, they are inflated for the currency exchange. So that helps slightly with the valuation to the companies. So I guess almost like in conclusion, talking about this is it's not ideal. Any uncertainty is not ideal. It's like when you have a ruck in your relationship. It's not great because you want things to run smoothly because there's so many things we want to achieve. We'd be much better focusing our time sorting out things like the NHS or our education system rather than focusing on a divorce party with Europe. But it's here. Therefore, let's look at the things we can control. Let's look at the facts. Let's make sure we're globally diversified. We're not just investing all our money in the UK. Let's make sure we're not taking any more risk than we need to or we feel we can tolerate. And certainly, let's make sure we don't change our investment philosophy based on what the politicians are doing. That should be that's set in stone and we just hold it. If we're drawing income from our investments, let's make sure we've got at least 3 years of cash or cash equivalent, preferably up to 5 years. So that carries us through any rocky periods. And then just sit tight, reevaluate, see how things are going. You'll see your pension statements go up and down depending on what's going on in the markets. But over the long term, capital markets do produce a positive return. The FTSE All Shares done about 9.5% a year. The US market's done more. So I don't want to blasé it, but it's not quite as bad. You know, I don't think we're going to see a 30% slump in property prices. Really, would you sell your house if it was worth 30% less? Would you buy another house? I don't know. It's unfortunate because I think it would help a lot of first-time buyers on the market, you know, especially at the lower end of the market. But I think the strict controls of the buy-to-lets, the higher taxation, the loss of interest relief on rental properties, has had a bigger effect on the property market than potentially Brexit will. If we see interest rates going up to double digits, which I'm not convinced we will, that will have a bigger effect on the property market. But I'm not sure we'll see a 30% slide in property prices.
All right, great. Well, thank you. Thank you for delving beyond the headlines a little bit. And I think it's worth saying as well, if there are any viewers that have queries over something they've seen or heard or read or whatever it might be, then please do get in touch because I know you love responding to the viewer questions.
Yeah, absolutely. Yeah, brilliant. Thanks, Paul. Good to speak to you.